The Fed cut rates by 25 basis points, but long-term yields went up. Have you locked in your rates yet? Hello, Diamond NestEgg members, super savers and course fans. I hope you're healthy and well, and welcome back to Markets with Marcus. So, as expected, the Fed cut rates today, and as expected by 25 basis points. So from a range of 4.25 to 4.5%, the new range went down to 4.0 to 4.25%. As I said, pretty much within expectations. In their reasoning, the Fed put out the following thoughts. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. Now, that is a bit Fed speak, and I can't blame them for that. They're the Fed. They can't really back themselves into a corner, so they need to have a little bit of a wiggle room, so to speak. But what do they really say? So I think what they're really saying is that they're in a bind. So inflation and unemployment are both those doing well. Normally, the Fed doesn't have that situation. Normally, either inflation is too high, but then usually you can just increase the rates, because very often that wouldn't hurt employment too much, because in times of high inflation, employment is often strong. Or employment is weak, but then usually you can lower rates, because if employment is weak, inflation is usually not running wild. But what we now have is inflation that is persistently too high and unemployment that is also too high. And that's the textbook definition of stagflation, so to speak. So if you wanted, you could say we see a bit of a mild case of stagflation. Could be clearly much worse. Now, what to do? As we said before, the Fed has only one tool that they can use, that's rates. It can go up, it can go down, they can keep it the same, but it's one tool. And they have two goals that are currently in conflict. Inflation, too high, you should up the rates, increase the rates. Unemployment, too high, you should lower the rates, cut the rates. So in this situation, the Fed decided to err on the side of protecting employment by cutting the rates. Not too much, at 25 basis points only, but then again, they also signaled that more cuts might be coming. So they really, from what we can hear, how we understand it, how I understand it, put us on a path to a gradual lowering of rates, given that they see an overall weakening economy. Now, Powell did a good job in getting basically everyone on the committee behind him. Only Stephen Myron, it was his first FOMC, first time he could vote, dissented and put it into the notes, into the meeting minutes, that he was pushing for 50 basis point cuts. So far, as expected, maybe less dissent than some observers would have expected, but the 25 basis point cuts as expected. So there are two big questions for most observers and us as investors and treasury holders. One, did the Fed lower rates because that's really what they believe is the right course of action? Or did they give in to political pressure a bit too much? And two, have they basically told us that they're willing to sacrifice inflation, so to speak, sacrifice price stability to protect employment? Now, let's see what the markets say. What you see here on this table is how the treasury yields along the range of the spectrum that's available changed from yesterday to today. So yesterday, the day before the announcement, today, the day of the announcement. And what we see is a more or less familiar picture. At the short end, so in this case, everything up to the 1-year treasury bill, yields went down. And on the longer end, everything 2-year and above, yields went up. And that's a picture that we've already seen when we had a look at past rate cuts. And the reasoning behind that, how I interpret it, is that at the short end, that's the rates that the Fed controls, that goes down in line with the Fed funds rate. Makes sense. On the longer end, that's the rates the Fed doesn't control. That's really determined by how the markets see the future, how the markets see the economy. And that's been going up, meaning the markets generally seem to think that those cuts will be beneficial to the economy, stimulate growth, and maybe bring a bit of a higher inflation where they want the premium. That said, while the effect in principle is the same that we've seen before after rate cuts, it's much, much weaker. If you look at the last row, the row that has the black and the red numbers, you see that the moves in basis points weren't really that high. It was like single digits, not more than 4 basis points. So same principle as usual, but much, much lower, much, much less significant. So let's now compare how we're doing in this cutting cycle. So on this table, at the very bottom in the white row, you see where Treasury yields stood along the entire maturity range on September 17th. It was the day before the first rate cut, so when rates were at their peak after the post-COVID inflation. And then you see the 4 rate cuts that the Fed has been doing since then. So you see that every time the Fed cut rates, the short end went lower. Those are the red boxes that you see on the left-hand side. And red and green, by the way, compares where rates are as of today to where they stood on September 17th, now when we had peak rates versus where we stand now. So you see that everything up to the 2-year after 4 cuts is yielding lower than it used to yield at peak rates. Makes sense. However, maybe a bit surprisingly, everything from 3-year and above is yielding higher than it was yielding on September 17th, 2024. So while the Fed has lower rates, while short-term treasuries yield less, the long end is up. We are still getting more for our treasuries than we got a year ago, especially at the long end, even though short-term rates are much lower now. Again, that's the same mechanism we mentioned before. The market seems to think that overall these rate cuts help the economy, help to avoid a recession, will bring more economic growth, and maybe also a little bit more inflation than if rates would have stayed high. Now, as you can also see, the risk profile is slowly changing over time, because the effect, the jump in rates at the long end, was much, much weaker today than it used to be when the Fed cut the last times. And that's really because of like 3 big questions. So the first big question is something that the Fed says it is watching closely. That is, how will our labor force develop? Chairman Powell said it in a nice way. He said both demand and supply of labor are shrinking in the US at the same time. That's a factor of a weakening economy and also of a changed immigration policy. So then a kind of a balanced state in kind of an equilibrium, but we don't know how that will develop. And the second big factor that the Fed says it is following is inflation, where they say those are not really clear where it will go. They seem to expect that inflation will not see much of a long-term impact from tariffs, more of a one-off. And we haven't really seen that much so far. But they see some early signs like goods inflation going slowly up, service inflation going slowly down. That gives them also pause for thought. So, as we said before, at the bottom line, the Fed decided that the risks to employment are higher than the risks to inflation. That's why the rate cuts and the path to more rate cuts. But we'll see how that goes. So, and the third big factor that we should be watching is something that the Fed hasn't been mentioning. They can't really say much about that. It's something the market is watching. How independent will the Fed stay? Will they stay independent, follow the dual mandate, or will they align more closely with the priorities of President Trump and his administration? So those are the 3 big questions. And net, the big question is now, depending on how that goes, how will the economy develop? and where will we go with rates. So what comes next? We'll have another Fed meeting clearly in due time. And we also have pending changes in the composition of the Fed Board of Governors. We discussed it yesterday. Myron is currently appointed until end of January 26, so just at interim. He may return to his old job as chairman of the Economic Council to the president. There will be a successor, presumably. Powell's chairmanship ends in May, and Lisa Cook is still going through the various instances with the lawsuits. So we'll see how that will develop it, whether the Fed will get more dovish. No one really thinks it'll get more strict. And one more thought on that, by the way. The Fed issues, now whenever they have one of these FOMC meetings, their latest projections about where they think the economy will go. Now, this is not cast in stone. These are very smart people, but they also don't have a crystal ball. So it's not just us as Diamond NestEgg who wish they had one, I guess. But what they predict at this point is that inflation will stay above their target rate of 2% until 2027, or maybe even until 2028. So yes, they say they're still confident to get inflation down to 2%, but they also acknowledge that inflation will take a while to get down to the 2%. So not this year, not next year, maybe end of 27, maybe 28. So summary of today, rate cut as expected, opening the door to more rate cuts. Now, one rate cut rarely comes alone. In the past, now we've seen before that whenever a cycle starts, it either goes up or down, usually in several steps. It's rarely just one cut, especially depending how the economy develops. And that's the reason why we're generally fans of dollar cost averaging. Now, given where we stand, given that long-term rates may or may not have peaked, I know that some of you have been locking in long-term rates with treasuries. Some of you have been sending Jen an email about locking in higher rates with annuities. So if you're interested in that, Jennifer@diamondnestegg.com. And some of you continue to roll over your treasuries at the short end to keep the flexibility. So let me and the community know. Drop us a comment below. Where do you think long-term rates are going? Where do you think the risks are? Is inflation more dangerous or unemployment? And what are you doing? Are you erring on the side of locking in those rates while they're available? Or are you more rolling over to keep your flexibility? Or maybe somewhere in between. So drop us a comment, let us know. And that was it for today. All right, Diamond NestEgg members, super savers, and course fans. I hope you enjoyed today's video, learned something new, and I see you again soon.